Hey, welcome back, everybody, to today's Market Explained. It's a 4-star media event, and we are here for a market commentary discussion. I'm Brian Kasal. I'm your host, and I have here my co-host, Mr. Christopher Reardon. Chris, welcome to the podcast.
Thanks, Brian. Good afternoon to everyone out there, and glad to be on the podcast and talk a little bit about the market.
Excellent. Well, Chris is our Director of Development for 4-star. I call him the master of all things portfolio, reports, everything. He still loves his Cleveland Indians and caretaker to his new golden doodle puppy, Hudson, who's probably not too new anymore. Hudson's getting old. Anyway, and a couple new Reardons, 3 to be exact. So again, Chris, he's our co-host, and welcome. And also, we have a guest who's going to join us a little bit, Jack Walsh, Trader Jack. He's father of 3, sports car enthusiast, experienced trader in the interest rate futures in the Chicago Mercantile Exchange. And last 15 years, he's been working as a senior financial advisor, working with the largest practice at 4-star. Jack Walsh, welcome to today's Market Explained podcast.
Thanks, Brian. Glad to be here. And these are very, very interesting times for interest rates. That's for sure.
They sure are. No doubt. Welcome, Jack. And I'm Brian Kasal, your founder, CEO of 4-star, Eagle Scout, National Boy Scout Foundation trustee, philanthropic advisor to CEOs. And I'm chief dad to Quinn and Evan and chief husband to the amazing Tripty. So that's the lineup for today, Jack, Chris, and Brian. And of course, everybody, if you remember, helping us with giving us a 5 out of 5 ranking would really help. We're getting a lot of acceptance of our show, and we'd love to have more and more people see it. And the better rankings we get, the better it is. So we'll do talk about the markets, we'll talk about the economy, and in general what we see out there, and give everybody a general update. So, Chris Reardon, you have the ups and the downs of all the different asset classes. So I understand there's been some big changes in the last couple weeks, and certainly in the last week. We taped about 3 weeks ago. So, Chris, give us an update on where we stand now with the market.
Yep. Definitely some big changes. We had about a stalemate for probably a couple months where things weren't moving too much. There was kind of a slow moving market from the asset allocation perspective. And now we finally have seen an asset class, for the most part, take control. So we have a new number 1 asset class, and that is domestic equities. So it moved up from the 3rd position to the number 1 position, and it gained 36 points from the last podcast to tally 277 tally points. So that moved into that number 1 position. Still holding at number 2 with international equities, and it gained 5 points from the last podcast, and it's at 248. So we are seeing a bit of a divergence there, a little bit of a lengthening between the number 1 and 2 asset classes. And then in the 3rd position, the former number 1 commodities has now moved all the way to number 3, and it's minus 22 from the last podcast at 224. So big changes, kind of a big shakeup in the first 3 asset classes. Cash is still holding in that number 4 position at 157 tally points, and that's minus 11 from the last podcast. Currencies is in 5th, minus 7 at 99 from the last podcast. And then fixed income is plus 1 from the last podcast at 82 in last place. So the big changes really occurred in the top 4, even counting cash, which was minus 11, the top 4 asset classes. But, I think it's good to see that we do have domestic equities taking kind of control, taking that leadership position, and really starting to actually distance itself from the other asset classes. And the international equities continues to do well. It gained 5 points. It's just not moving at the speed that we're seeing domestic equities move in that upward direction.
Nice. So, Chris, this is quite a change. I mean, commodities were in number 1 position last time we met. So they're now to number 3. And then for domestic equities to move up 36 tally points and be way, way far ahead of number 2, that's a major change, isn't it?
Yeah. And these are definitely major changes. And, I think some of this is due to, some of the recent posturing by the Federal Reserve and the anticipation of potential rate lowering of interest rates, things like that coming next year. So that's what's causing not only the boost to domestic equities, but I think it's also causing potential commodities to pull back. We've certainly seen oil and other commodities that have drove commodities up have certainly helped pull it down now in the last week or two.
And we had like a bad month in oil after oil being very strong, and then this past week was strong again. So we'll see if that is the bottoming and oil prices start moving back up again. There's a lot of reasons why oil might want to move back up again, but we'll see. Time will tell. Last week was the first reversal week from a big decline, so we'll see. The other thing, Chris, is the domestic equities, U.S. stocks moving up to new highs now that or to a high tally score number one, and then new highs in the absolute indexes. So that's a sign that the economy could perhaps be done with this recession or whatever its slowdown is. It's a sign that the market is signaling things are going to get better, but who knows whether that's true or not.
Yeah, I mean, I think that right now there's a certain, I don't say euphoria, I guess, in the markets. There's this hope that the Federal Reserve is going to cut rates sooner rather than later, and that's going to drive the markets higher. But I think also a lot of the earnings in Q4 has been better than expected. I think what we're starting to see, at least maybe an inkling one, is that maybe Q1 earnings potentially are weaker. I did see Accenture, which is obviously a very large consulting and company. They said that their estimates are coming in weaker and what they're projecting in Q1. So maybe we're just getting lagged a little bit. So it's kind of the last little hurrah. But only time will tell. We don't know. I think a lot of people anticipated the market to be pulling back more now than it has. It seems very resilient. So no one really truly knows.
The market may be ahead of itself, but Chris, Jack is here with us, and Jack was our interest rate observer, worked in 25 years on the Chicago Mercantile Exchange. Jack, tell us what you see. What did Powell do, and what is really happening in this bond market right now?
Yeah, well, I think we want to start with the backdrop, right? So, we saw rates go from basically 0 to 5.25, 5.5. And what were the circumstances with that, right? You had banks that have treasuries in their asset portfolio, right? And they had loans out as far as mortgages and such go. And as the Fed started to raise rates, it caused problems in the banking systems. Silicon Valley Bank, right? We had a lot of regional banks get hit. And, why is that? It's because their portfolio of treasuries was getting crushed, right? So much to where the Fed put in a facility where banks could borrow money from the Fed, transfer securities to the Fed, and borrow money short term. And the other thing that was in the backdrop, remember when the Fed increased the supply of treasuries because we have such large deficits, right? You had auctions that were so-called very sloppy, meaning that there was not as much foreign participation. You also had the dealer community that had to take a larger percentage. And then Brian, lo and behold, we had that one very good inflation number. Remember that? And that started the bond rally, right? 10-year notes were at 5%, and that started the bond rally. Anybody who's in the business of trading and buying securities, they want their financing rate, the money that they borrow to purchase those securities, to fall. So when the Fed had its meeting and there was a question asked to Powell about the potential on future rates, and he basically said that the Fed would consider lowering rates, that was kind of the green light to go in and buy treasuries. So that's what happened last week. It was on Wednesday, and we had a massive rally in the bond market. We also had a so-called risk-on trade. When the Fed is thinking about lowering interest rates, the dollar falls, and it's time to get back in the pool, right? And what's interesting about that is you and I saw massive money coming out of the banks and into institutional money markets, right? And that flow, I believe, got to close to $2 trillion sitting in institutional money markets. I don't think you and I in our 35, 40 years had ever seen that before, maybe in the 70s. So anyways, the Fed, I believe, saw the damage that was happening to the financial system, happen to the banks. They want to stop that flow out of the banking system into money markets, right? So some of that money going into stocks and bonds is moving back out of money markets, but I still think that those rates are still relatively high. I mean, people in 2022 that were earning, 475, five and a quarter, really considering the backdrop, that was not a bad deal, right? So right now, I'll tell you that the market is now starting to factor in at least 3 cuts. There's 65% chance that they could go in March. But what that has done, if you look at the financial stocks, look at a big stock like Morgan Stanley. Just weeks ago, it was trading at $69. Now it's up to 91. Some of the regional banks and the bank indexes have rallied 15, 20, 25%. So something that was very painful for the banks, the Fed has stepped in and at least short term thrown them a lifeline. I'll stop there.
Yeah. So we've seen that here at Four Star as well, where many investors were in bonds. Bonds are doing well. Rates are low. They had losses in their bonds, and they just said, "I'm going to get into a money market fund at 5%. There's no sense here. I can use the tax loss against other gains." And they got out of the bond because the bonds weren't paying much. And so we've seen that here. And now there is so they're giving some happy talk right now about lowering rates, and that's also a signal that they're expecting the economy not to be as bad as it was. Plus inflation has come down. But Jack, it's possible though that inflation goes back up, right? Like, what if oil prices go back up and other things that predicated this move? So it's not really assured that the Fed is going to do this, even though the market's betting on rates going down in March. Maybe they don't, right? Still possible.
Yeah. Yes. And it's very interesting that you say that, because just a day or two after the meeting, Fed governors are coming out and pushing back and saying that, no, we're not talking about cutting rates. Because what happens, Brian, is that when the market feels that there's a shift in interest rates, then currency traders go in and start to sell the dollar. As the dollar falls, prices of commodities start to rise, right? Commodities for us are priced in dollars. As the dollar falls, commodities rise. So exactly what you're saying, what the Fed did short term is definitely help the banks and the financial markets, but longer term, it could be very detrimental for inflation. And that's why, even though the 10-year note went from 5% to 390, you don't see a huge appetite now at 390. You know why? Because inflation is still at 3%, right? And we know that the Fed's goal is to get it back down to 2%. So the market believes that the Fed is trying to so-called stick this soft landing. So
very interesting. And we did see this very strange interest rate spike to try to kill inflation over the last year. And anybody who was around in the 1970s remembers that as well. It got significantly higher, but it had started from a higher level. And then the fall of last year, around this time, we saw some currencies that went aflutter. The Japanese currency, the Switzerland had some trouble with Credit Suisse and other things. So there were some messy things going on last fall because of interest rates spiking so quickly. And then, of course, in the spring, that we had all those banks go down, Silicon Valley being the biggest and a couple others. So what hasn't happened yet, though, that did happen in the 70s and early 80s, were literally dozens and dozens, over a couple of hundred banks went down through interest rates, and due to the mismatch of rates inside the bank. In fact, they got so bad they had to come up with Resolution Trust Corp. Any of the old timers might remember that under the Reagan administration to actually bail out all these savings and loans. And they decided to end the savings and loan industry. No one's heard of a savings and loan in 40 years. And now everything became an FDIC insured bank. So it got really, really bad. So maybe by Powell making this move, this happy talk move about rates possibly going down, he saved that from happening possibly, right?
Yeah. And the other big negative side effect, Brian, is real clients, institutions are now questioning whether the Fed is becoming political, right? Always it was hands off the Fed. Now we've got a election in 2024, and it looks like they are becoming very political, which for a central bank is just awful, right?
They're not good. They got to do the right thing and not worry about the politics of it.
Exactly.
Well, great. Well, Jack, that was a great explanation. We'll see what happens, but right now the bond market and all the players in the bond market, by the bets and moves they've made, are predicting a high probability of an interest rate decline in March and then 2 more later in the year, right?
Yeah, I think the question will be, Brian, exactly what you were saying earlier. I think the Fed is going to lower rates, but it's going to be what happens to inflation expectations as they start that move. When the Fed lowers interest rates, everybody jumps in to what they call the front end of the curve into the 2-year note. But what happens with that is it changes inflation expectations, and then long end rates start to fall. They talk about curve steepening, meaning everybody jumps into the front end and long-term rates stay where they're at and they start to rise, right? So I believe that the Fed will do it for the financial system, but it'll be very important to watch inflation expectations, which is exactly what you were saying before.
Yes. So let's hope inflation doesn't reaccelerate. If it does, then this all changes. But right now, that's what we're seeing, right?
Exactly.
Okay. Well, great. Well, thanks, Jack. Thanks for joining us. I know Chris and I are going to move on to talk more about the general what's going on in the economy right now. But thanks for joining us, Jack, on today's Market Explained.
Thanks, Brad.
Thank you. So, Chris, you've got some numbers on inflation and consumer spending, PPI. Why don't we go through all that?
Yeah. So you have some important numbers dropped since our last podcast. The producers price index came out. It rose 0.9% in November, which was under estimates. And I know we've talked about this on here, but the producers price index is a good early sign as far as what the consumer price index will be. If the producers is paying more, usually he ends up putting that on to the end consumer. So that's a good sign that it was less than the estimate. So we'll have to see if that continues, if that plays out. And then the Commerce Department reported its overall index of consumer prices. So this is what they kind of calculate. Was flat in October from September. It held steady at 3% year over year. So good movement there. That's positive. Inflation numbers. And that's the smallest year-over-year gain since March 2021. So that was when we kind of first started to see potential inklings of inflation. We were still kind of in the pandemic. We had supply chain issues, things like that going on. So right now, the numbers we're seeing from an inflationary standpoint have been good. And that's what's driven kind of what Jack was talking about and has propelled this 3 rate cut anticipation for next year. Core prices rose 0.2% in October from September, coming in at 3.5% year over year. And that's the smallest gain since April 2021. So once again, another good reading there. Consumer spending rose 0.2% in October. That's down from 0.7%, a 0.7% rise in September. That could be the first sign. So it's still positive, which is good, but that deceleration from a 0.7% to a 0.2% is pretty significant. It could be the first sign of the consumer starting to reel in their spending. That was the first month as well that we had student loans start to kick in, or the anticipation of it was in October. So we'll see the impact that these potentially have on the overall market.
Mhm.
Then moving on, we had the inventories. The merchant wholesalers came out. They were 0.4% lower at the end of October than September. So overall inventories, which can have an impact on inflation. Obviously, we saw during the pandemic lower inventories and that lead to higher prices. But they have remained, I think, stable, which is positive. Durable goods prices have fallen year over year in the last 5 months. In October, they were down 2.6% from their peak in September of 2022. So durable goods include, and the major drivers were appliances, furniture, used cars, kind of goods that you expect to last over a year. So that's good to see. The prices of home rentals, car insurance continue to climb, but they are showing signs of slowing. They were up 4.4% in October from the year earlier, but that was down from the 4.7% reading in September. So home rentals, car insurance, which is, I think we've talked about that. That's the housing situation, especially in the rentals market, continues to be a problem. It looks like it's starting to ease somewhat, which is good. And then we got a jobs number. Employers added 199,000 jobs in November. That was a slower rate than early 2023, and even over the summer we were seeing very good jobs numbers. But this could be kind of a return to normalization. This was the good jobs number when pre-pandemic, before we had this major distortion with layoffs, and then you had the people swarming back to the market and a really tight job market. So hopefully we're seeing kind of a renormalization there as we continue to kind of exit post-pandemic and kind of go back to business as usual.
Mhm.
And then in the housing market, a couple different numbers were released. The S&P CoreLogic Case-Shiller National Home Price Index rose 3.9% from a year earlier in September. So that's year over year. That was an acceleration of the August year-over-year number, which was 2.5%. So we see that the home prices continue to rise. We had a little bit of a reprieve kind of towards the end of summer, but we're starting to see those rise again. The September reading was actually the highest level of the index since it began in 1987. So we're at, really historic prices, if you will, for home prices, which is the supply and demand continues to be a major issue in that market. And then existing home sales decreased 4.1% in October from September to a seasonally adjusted 3.79 million. And that's the lowest existing home price sales or existing home sales since August 2010. So, it's been over 13 years since we've been at that. October sales were down 14.6% from a year earlier. So the housing market, we still haven't really seen. It hasn't relented, if you will. So we're seeing housing prices continue to creep up. They've stabilized a little, but they are starting to inch back up due to supply and demand issues. And we're seeing that existing home sales, which is for supply, really a good gauge of the supply, continues to be weak and at all-time lows almost. People willing to sell their house. So, it'll be really interesting if we see rates start to come back down. That could obviously unwind a little bit of the housing market. If rates go back down sub 5, maybe into the 3s and 4s, we could see some homeowners actually consider selling their house and moving again, and that would free up a lot of supply in the market. So we'll just have to kind of wait and see, though, and see how that impacts. And then on the international front, a couple highlights I'll point out. India continues to be a major outperformer on the countries with major economy or major economic countries. Their GDP at the end of September was 7.6%. That was only slightly lower than their Q2 GDP of 7.8%. So, India continues to be a major player in the global economy. Their biggest GDP contributors were manufacturing and construction. And I think a lot of that they're gaining off of, China and some of the friction that the U.S. and other countries have been having with China. And also, when we had the pandemic, Obviously, we saw tightening, we saw restrictions in China, and that caused supply chain issues. So I think we're seeing people are trying to spread out their manufacturing processes and try to incorporate different countries so we don't run into those bottlenecks anymore. And then the last thing I'll highlight is oil prices. We talked about a little bit. So last week they hit an all-time 6-month low, about $73 a barrel. Brent crude is that. So we have seen a little bit of a bounce here. And it's really interesting because the low is off of, essentially they're keeping the supply the same, but the prices have come back due to demand. So the anticipation that demand is going to be weaker than expected. Essentially, they're anticipating a potential recession, maybe not as bad in the U.S., but in the global markets that is going to weaken demand. And it'll be interesting because if the Fed sticks the landing, if we see rates kind of lower again, and we see demand stay the same, if not strengthen, we could see, as Brian said in the beginning, we could see oil move right back up, which could cause inflation again. So it's interesting. We have seen it kind of come off that bottom in the past week, that 6-month low, but we'll see how that kind of plays out in the next month or two.
Exactly. Well, and also in addition to India, Singapore is having a good run as an economy. So some of the other countries, not China, are doing much better, where people are fearful of China, but they're moving to India, they're moving to Singapore, other countries that can do business without all the political tension. Right?
Yeah, that's very true. I know Vietnam, I think, is another one. Other countries kind of in that region
Right.
have benefited from that.
Right. Well, and then President Xi, was trying to get back to business. He did have a meeting in San Francisco, the Chinese president with our president, and then of course with the governor of California. And we think that was an attempt to get back to business. They went too far with all their kind of political stuff, and so people are a little scared of China. So there's been a move out of China into other countries, and that's still continuing. So I don't see even that visit to California really changed much, but we'll see how things play out there. If you create political instability, business people don't want to be there. And that's what they created, because they were using their power as a country to control people, control businesses. Like, they owned all the businesses and they wouldn't give you the autonomy that you wanted during your business. So business people need that. So we'll see what plays out there. So we have a strong job market, and now the Fed's lowering rates. So we'll see, or they're talking of lowering rates. We'll see what happens. That jobs number that you mentioned, though, the components of that job market were mostly government or healthcare or education. Most of all job growth was down in other categories, though, right?
Yeah, correct. I mean, we are seeing, I guess, a slowing of the job market in the private sector. Public sector has picked up some of that slack, which has been represented, in that aggregate number. But private sector, we definitely have seen, and even people have heard on the news about some layoffs or anticipated layoffs through some major companies.
Yeah. So we'll see how the jobs continue. But with that component of jobs, that's not as positive a report as people would have thought. And then, of course, the government borrowed $2 trillion again last year. And yes, we're in a little bit of wartime, certainly with the Israeli war now, but that was last year, or that was this year, not last year, in the fiscal year, that is, the fiscal year ending October 31. And then also, the Ukraine war. But, that's significantly more than we used for that war. So we're still borrowing massive amounts of money during, a time when we don't really need to, running huge deficits. So that's not a positive thing. It could be an existential issue for America. So we need to watch that very closely. Consumers are still spending, but they're adding debt, Chris, as you might have mentioned. The income numbers are not keeping pace, but they're adding in they're up to about $1.1 trillion worth of consumer debt, which is now an all-time record level. So it's pretty crazy. The consumer spending will slow down if at some point, when the credit cards are all tapped out and people can't, spend money that they don't have because they're not getting the same wage increases. So we'll see if that does anything to slow down the economy. And then Chris, there was some discussions about Ford and their recall, and then a 50% whiskey tax, right?
Yeah, and it was actually Tesla that had to recall. Tesla recalled more than 2 million vehicles over concerns of its autopilot system and the misuse, potential misuse by drivers. So that was obviously a big hit. I know Tesla likes to push the boundaries as far as what a car can do, the autopilot, and a lot of those, and they're heavy in that space. So it'll be interesting. I know some of the government regulatory authorities have been keeping a close eye on this. It makes sense. Obviously, you don't want cars driving themselves that, can't handle traffic patterns, things like that. So it'll be interesting how it plays out. I know a lot of other large car companies are in the same field. So this could set a precedent moving forward. So it's something to keep an eye on. And then one of the collateral damage, if you will, of some of the fights going back and forth from the trade side between the EU and the US has been whiskey. So potentially starting in 2024, whiskey makers in the US shipping their bottles to the European Union could potentially face a 50% tax on that whiskey. This comes after they're threatening this tariff, I guess, on top of as retaliation for the U.S. tariffs on EU steel and aluminum. So that we're still seeing it. You don't hear about it as much. If you go back 2 or 3 years ago, you saw a little bit more of this kind of tariff news as far as the steel, aluminum, other products. But it's really interesting that they targeted or they're potentially going to target such a small industry in the U.S. and it could have implications, especially for whiskey makers here, which might not have the biggest margins. So could be something that plays out where they're not going to be shipping abroad as much.
Exactly. And Ford is slowing down in electric vehicles now. So even with all the subsidies and all the political talk about wanting to get rid of fossil fuels are probably not going away anytime soon. And even the car manufacturers that even are heavily subsidized by the government to create electric vehicles, even they're slowing down now on building electric vehicles. They still have battery issues. It's not quite what everyone wanted, and certainly not the robust nature of fossil fuel cars. So we've seen that happen also. So the whiskey tax is an interesting development. Chris, the Hollywood writer's strike, second longest writer's strike in history, it did finally end, but we're seeing now that strike changed the market a little bit. So over time, they've been issuing less scripts. Independent studios are now issuing those scripts. So it's changing the way things are happening within the industry because of the settlement they came up with. So there's a lot of changes coming in brewing in Hollywood. We talked about the consumers adding so much debt. I'll also mention about Hollywood that there's now a whole group of Hollywood stars that say they're leaving if President Trump gets elected. And right now, the polls show that he is in many areas way ahead of President Biden as his poll numbers get worse and worse. And so that can certainly affect the economy also. One quick one, McDonald's is opening some new location called Cosmics, and they're kind of new and hip and different. And they have 1 in Chicago and 9 in Texas. They're targeting Starbucks, and so they're going to have coffee and afternoon pickups. So they're directly competing with Starbucks, and I thought that was interesting. So maybe things will change there. I know the price of a Starbucks coffee or iced tea has gone up dramatically in the last couple of years. So maybe that competition will bring some of those prices back down. We'll see where that goes, Chris. And there's a backlash going on with DEI, diversity, equity, and inclusion, where now most folks realize that was very much of a political thing. And so like Disney, for example, Disney has not really had a really positive first run release movie in a number of years now. They used to release and have huge success, top issues and record numbers when they had movies coming out. Now the public has realized that they're very political, And the diversity, equity, inclusion program is more political than it is, entertainment. So we used to go to Disney for entertainment, and now it's politics. So it's cost Disney in a level of billions and billions of dollars by unsuccessful movies. So we'll see if that makes them change their stripes a little bit. So just more into what we see out there. The last one I wanted to highlight was there's a new company in Chicago that is issuing hot tub boat rides. So when you're hop in the boat, you're in actually a hot tub cruising down the river. It's quite interesting. So even though it's hot, even though it's cold out now in Chicago, people are riding in hot tubs in the Chicago River. So have an interesting trend. We'll probably see that around the country, but we thought that was interesting. We wanted to point that out. So, Chris, there's a couple blog posts out there. There's one a couple weeks back, and it's about to regulate or not regulate. That's the question for big tech. And so we've seen now also a lot of political trends in the technology world where many of the people in the technology world are of one ideology, and they're using their power and technology to get their politics across. And there's a big backlash, and there's talk of regulating the technology industry to keep them from pushing their political agendas through technology. So there's a big war going on in Congress for that. So we'll see how that plays out. And so that's the latest blog post. There's numerous podcast interviews as well. We can see all those at Today's Market Explained. We've done an interview with Scott Clark, who's the head of True Life Companies, which is the land development company. And so there's some interesting interviews out there. So everybody look at Apple, iTunes, Stitcher, Spotify, and you'll see Today's Market Explained, and you'll see those interviews. And you look at our website and today on the Leadership Matrix, and you'll see those blog posts as well. So I think that's all we have for today, Chris.
Yeah, I think that wraps it up.
Okay. Well, great. Well, thanks for everybody being with us again. We'll be back with another interview very soon. And that's it for our episode today at Today's Market Explained. We'll be back soon. Thanks for being with us today, everybody. We'll leave it there.